They were the two dissenting votes. In terms of the color here on how the Bank of England has framed the decision, the CPI inflation is set to peak at 3.7% in Q3. In November, the peak was seen at 2.8% in Q3. So that is a change. Return to target expected in Q4 2027. Governor Bailey saying we will take a gradual and careful approach to reducing rates further. And in December, the wording was a gradual approach. So they've added the word careful. Make of that what you will. We'll see, James, what you think about that wording change in just a moment. GDP expectations, we're looking at growth in 2025 of 0.75%, down from 1.5% forecast back in November. 2026 revised to 1.5%. We were looking at 1.25% in November, so that's been revised slightly higher. 2027 growth seen at 1.5% versus 1.25% expected previously. So basically, they've downgraded their growth forecast near term for 2025, but they've slightly upgraded it for 2026 and 2027. Members expressed a range of views on the economic outlook. And one member who voted for a larger rate cut sought activist signal on appropriateness of UK financial conditions. So that is that is interesting. So external members Dingra and Mann voted to cut rates by 0.5 percentage points to 4.25%. So that is really interesting. Let's bring in Jane Foley, our FX strategist from Rabobank, to give her take on not only the decision, but Jane, I think the most gripping part so far, not only the changes to the economic forecast, but these two dissenters.
Absolutely, those two dissenters, and that is something that is going to get the market's attention, as you've been discussing. The market was expecting Catherine Mann to highlight the more hawkish case for the market, and it was going to be, as far as the consensus was concerned, a fairly straightforward voting pattern, which is not what we've got. So that is clearly going to get the market's attention, but also that downward revision to growth in the near term. Now that is something else that the market is going to be focused on. Now, not a huge surprise that we did have the Bank of England in December revising down its expectations for Q4 growth relative to that November forecast that they had made. So I think most people had anticipated that we would have a downward revision to growth for this year. But it does raise the question now, even though the bank, of course, have a mandate that's focused on inflation, well, the inflation in 12 months' time or so is really going to be dependent to a large degree on how growth is doing. And if we do have weaker growth, does that mean they're anticipating weaker inflation and therefore more room for interest rate cuts? So I think these are the topics that the market is going to be discussing.
Jane, thank you for your take. James, let me come back to you. We were just discussing before the decision that Mann was expected to be a dissenter, but not in this direction, not calling for a 50 basis point cut.
Absolutely. That does surprise me. But the thing that doesn't surprise me, really, is that sticky inflation. And that sticky inflation has been something that we at Handelsbanken have been saying for some time. This is going to be the problem. How do we get that service sector portion of the economy? How do we get people, largely about wages, how do we get that number to start to come down? And that's a challenge. And I think it's something the bank really looks at. And that's going to be driving their interest rate decisions going forward. It's the one thing that certainly I look at, I know the Bank of England MPC looks at a lot. What's that service sector number?
Another line I want to bring your attention to is around tariffs. This is clearly a big macro risk for central banks. The BOE saying it's monitoring U.S. tariffs closely. More protectionism would have a negative impact on the world economy. So not a huge amount of color in the early moments anyway on what it might mean for the UK specifically. How do you think they're factoring it into their models, and how will that complicate the inflation picture here? I
think there's a couple of points here that are really interesting. One is that, of course, there's a lot of discussion about how inflationary are tariffs, and the answer is it's difficult to say, but the feeling for the UK is probably not all that much. Now, the UK runs actually quite a good trade surplus with the US, but it's almost entirely down to services, which of course are not subject to tariffs. So I think that what President Trump is doing is using tariffs as a weapon to sort of get people's attention and to get his way on a wide range of issues. I mean, it might be, you're talking about trade, but what he wants is, for instance, you to raise your defense spending to the promised levels of NATO commitment, etc. So he might be looking for that. I think what's going to be happening here is a lot of trade. He wants deals to get done, and so he'll look for that, and that's fine. He's the president. He wants to do that sort of thing, and I don't think that it's going to be particularly impactful on the UK in the short to medium term. We'll see what happens in the longer term, but right now, I'm not particularly worried about tariffs from the UK's point of view.
Well, James, thankfully you're sticking with us. Jane Foley is also going to stand by. But now let's get out to Steve, who's been locked in all morning. Steve, the market is surprised by these two dissenters. Not what they were expecting. We're seeing the pound drop by about 1% versus the dollar. Give us the detail that you've got.
Well, I think the market's wrong. I mean, sorry, I'm going to go for it. Yes, okay, they're looking at the headline. They're looking at the rate cut. Great, 25 basis points. They're looking at the two dissenters. One of them we knew was anyway, Swati Dinger as well. But Catherine Mann going from being the hawk to going for 50 basis points as well. That looks really dovish, but the market needs to look deeper in the NPR. And luckily, I've been doing that as well. There are less rate cuts ahead forecast, i.e. forward projections, first quarter 2026, we're basically seeing the growth estimates going down, inflation estimates remaining very, very sticky as well. But over the longer term period, the projections for interest rates remain higher than the market had previously expected, i.e. We're looking at potentially only 4.2% by rate levels, base rate level, by the end of this year. And by the end of the forecast period in 3 years, only 4% as well. So if the market thinks this is dovish over the medium to longer term, that's not what I'm hearing. In fact, I think very much this is a hawkish cut in many ways. I see what they're saying about Catherine Mann, but look beyond it. They're saying here in the report as well, risks are two-sided. Andrew Bailey talking about gradual and careful as well. And also, I think there's some underwhelming data in the growth. Market might be right about the growth data as well, because in the first quarter it was seen back in November at 1.4%. It is now seen at 0.4% and only gradually moving up to 1.8% by the end of the forecast period in 2028. So in terms of interest rates, they are not going to go down according to these projections as swiftly as the market wanted. Let us take a step back from what we've been saying as well. The market was expecting around about 85 basis points of cuts this year before this decision. Well, we've just had 25 basis points of those, but where are the other 60 going to come from? Well, according to this, they're not, because we're only pricing in another 0.3 of 1% from where we are at 4.2% as well. The problem is also about inflation, and this is going to be very tricky and very bumpy, according to what the Bank of England is saying. We could see a spike in inflation in the third quarter of this year to 3.7%. Wow, think about that. I've just said to you at the end of the first quarter, growth is going to go down to only up 0.4 of 1%, and only a couple of quarters later, inflation up to 3.7%. Hang on a second. It feels and smells like stagflation. No one at the Bank of England is going to say that. No one at the Treasury at number 11 Downing Street is going to want to say that. But there are people who are going to add two and two together and say, have we got stagflation in the UK? Now, the Bank of England isn't saying that. In fact, the Bank of England is saying the external factors which are taking us up to 3.7%, including regulated price increases from Ofgem, plus international global prices and energy, they will abate and we will get back to 2% inflation by the end of the target period, later on in the target period as well. But there will be those there of saying this is going to be a very delicate equation for the Bank of England. A couple of other factors I want to factor in there as well. I've just been looking at where the growth is from the government strategy as well. Where's the growth expectations from the government's budget? Of course, this is a government that says growth, growth, growth. Well, how about this? According to the agents, according to the Bank of England, business indicators declined. Consumer confidence declined. Labour market continued to ease. That doesn't look good to me. Productivity growth is weaker as well. Where is the growth from the government strategy? There is a feeling that because it's about big infrastructure projects, it's about Heathrow, it's about broader structural changes, it will come through towards the end of the period. But again, I say to you, 1.8% is the forecast for first quarter growth in 2028, only 1.3% in 2027, and as I mentioned earlier, only 0.4 of 1% in the first quarter of this year. Growth looks stunningly hard to achieve. Final point I want to make as well is there is a whole box and a whole section later on in the NPR. I did go through the whole thing. Looking at the implications of international policies, of what's going on with tariffs and Trump as well. Very, very difficult, I can tell you, for them to judge anything from there as well. But they have been adding that financial market volatility has been leading gilt yields to follow the US rather than take a European path. And I thought that was very interesting. Anyway, we'll be asking a lot of these questions of Andrew Bailey. That one is 4 p.m. London time. Yes, the market's right to see the growth figures as concerning, but the market, if they think this is a dovish cut because of what Catherine Mann has seen there, I would suggest the market needs to look at the forward projections on interest rates in this year and by the end of the forecast period. Back to you.
Steve, brilliant context. I'm glad that lock-in was worthwhile. I think that's really helped frame the decision and help us understand and how to think about this 7-2 vote. So thank you so much. Let's get back to our guest now. James Spruill is still with us, Chief UK Economist at Handelsbanken, and Jane Foley, Head of FX at Rabobank. Jane, let me come to you. We've watched sterling continue to sell off over the last 10 minutes since the decision has come through. My colleague Steve, you probably just heard him. He's been in the Bank of England all morning. He said this is a hawkish cut, despite the fact that we had two dissenters calling for 50 basis points. What do you make of that, and what do you make of the sterling reaction?
Well, if that is the detail, the devil is always in the detail. The sterling bears are going to come confronted with some buying pressures, probably as the Bank of England begin on their press conference. Now, certainly, I think the inflation risks are certainly going to be, key as we look over the next quarter, the next 2 quarters. And we know that there are inflation risks. So for instance, energy prices, that budget, of course, and the possibility that employers will pass on that national insurance contribution into their consumer base. There are headwinds certainly for growth, the tight labour market, but the tight labour market does appear to be abating. This slowdown in growth would certainly play into that court. So the risks on inflation are both sides, and I think this is going to be something which is really going to play out during the course of the next 3-6 months and the course of the year. To what degree are the weaker growth outlooks really going to help suppress some of those inflation risks that we are confronted with?
James, what do you think about the Bank of England's handle on the situation here? Is there credibility in question, or do you think that the market can still be confident that they are, handling the situation well?
I think the Bank of England, I mean, they've had some questions, obviously, the last couple of years, in so much as they thought inflation was transitory. It clearly wasn't. It went up to 11%, way over their target. So that, I think, probably hurt them a bit. But more recently, I think they've actually been pretty good. And so I think they do have a reasonable amount of credibility. I think people are clear that the Bank of England itself is focused on that one thing, inflation. And as Jane was saying, some of the pressures that the UK economy is under in terms of labour markets, etc. I'm not quite as sanguine, because I think that what we saw in the last few years was quite a lot of labour hoarding. Business is very reluctant to let people go. I think that's also contributing to the fact that people are getting reasonable pay increases to help them cope with the inflation that we've seen over the last couple of years. And that, of course, is adding to inflation going forward into our forecast period. And so it's going to take some time to really push it down out of the economy as a whole. And the Bank of England is very conscious of that. And so I would welcome today's not just the cut, but also the wording that goes around it, which I think is good. Slower for longer is absolutely in line with what we think in terms of sticky inflation.
So we're, in a nutshell, looking at higher for longer when it comes to rates.
Absolutely, we are, yes, absolutely.
And how concerning is that from a growth perspective?
Well, I mean, of course, the Bank of England, that's not their mandate, so they don't care.
Right.
It's a big problem for the Chancellor, of course.
Right, and as an economist, I mean, what do you think? What's that going to do to growth?
It's going to keep it subdued. And the Chancellor gave a big speech last week where she set out what she wanted to have, the economy growing. And there were some surprises in that speech. And one, she brought at Heathrow, but that sort of been reheated. Many people have wanted to see that coming through for a number of years. But the other one was no addressing of some of the issues that really concerning business. There's been a lot of concern around the Employment Rights Act. No mention of that. And so perhaps that's something the government can look at. If you want to reassure business, you want to spur growth, you've got to look at everything. And that might be one of the things that would bear looking at a little bit more.
Jane, let me come back to you to wrap things up. When it comes to sterling, we are seeing a sizable move today. What do you think is fair value for sterling, and what would you be doing here? What would you be advising your clients to do with the currency down by more than 1%?
Well, I would imagine that cable is still going to be knocked around quite a lot by the political and economic developments in the US. But in terms of euro sterling, yes, sterling certainly had a setback today. But if this does come across eventually as a hawkish cut, well, sterling can pick up some of that ground. Now, I think when you look at sterling against the euro, we've also got to look across the other side of the channel and recognise that there are growth issues in Germany and in France. France had some better news this week, but certainly it still has concerns regarding its budget. So sterling may still be able to outperform the euro this year, but I think a strong dollar is going to keep sterling on its toes with respect to cable.
Jane, thank you for sharing your view with us. That's Jane Foley, FX strategist from Rabobank. James Sproul, chief UK economist from Handelsbanken, has been with us to digest the decision. James, thank you for joining us. Do stay with CNBC. We will be bringing you Steve's interview with the Bank of England Governor Andrew Bailey. That's coming up at 1600 GMT. But that is it for Decision Time. We'll hand you back to our colleagues stateside.
Right. Good afternoon, everyone. Thanks very much for coming. Welcome to the Bank of England for today's session on today's rate decision and the February monetary policy report. We're joined by Claire Lombardelli, the bank's Deputy Governor for Monetary Policy, Dave Ramsden, the Deputy Governor for Markets and Banking, and of course Governor Andrew Bailey. We'll start with some introductory remarks from Andrew and then move to questions after that. Andrew.
Thanks, Jamie, and good afternoon. So today we've cut bank rate by 0.25 percentage points to 4.5%. With the progress we've made to reduce inflationary pressures in the UK economy, we've been able to take another step to make monetary policy less restrictive. And this will be welcome news to many. And we expect to be able to cut bank rate further as the disinflation process continues. But we will have to judge meeting by meeting how far and how fast. We live in an uncertain world, and the road ahead will have bumps on it. We expect inflation to increase this year to a peak of about 3.7% before returning to the 2% target. And we will set bank rate to ensure that it does so sustainably. Low and stable inflation is the foundation of a healthy economy, and we will do our job to continue to ensure that. I'll now describe the outlook for inflation in more detail, the uncertainties we face, before concluding on the decision we've taken today. Chart 1, as has come up, shows the development of 12-month consumer price inflation since 2021, that's the white line. It shows how headline inflation fell sharply through 2023 and into 2024 before reaching the 2% target towards the middle of last year. In the shaded area on the right, you can see how we now expect inflation to increase to about 3.7% towards the middle of this year as negative contributions from energy prices, that's the orange bars, first fade and then turn slightly positive, with some further upward pressure from food and goods prices, that's the purple and blue bars. And this is a full percentage point higher than the peak we expected in November. But behind this uptick in headline inflation stands a continued gradual easing of underlying inflationary pressures in the UK economy. And this is the backdrop to our withdrawal of monetary policy restrictiveness and to our policy decision today. As chart 2 shows, inflation in the prices of services has been coming down since the middle of last year. That's the blue line. In the latest data for December, services inflation fell more than expected to 4.4%. Some of that downside surprise was driven by smaller than expected increases in airfares, which can be volatile. But other measures of underlying services price inflation have been gradually easing too. And higher frequency measures of underlying services price inflation, which can be indicative of near-term inflation momentum, have remained lower than their annual rates. And this points to a prospect of further moderation in underlying services price inflation. Wage growth remains an important factor behind the remaining persistence in services price inflation. Annual growth in private sector regular average weekly earnings, that's AWE, increased to 6% in the 3 months to November. Now, this may suggest that the disinflationary process has slowed in recent months. The news from other measures of private sector regular pay growth has been mixed. The bank staff's indicator model of underlying pay growth has plateaued recently, as chart 3 shows, but it still points to a lower rate of wage growth, that's the orange line, than the AWE, which is the blue. And both the bank's decision maker panel and our agents' annual pay survey point to a softening in wage growth over this year to just below 4% and 3.7% respectively. So while we expect inflation to rise again over the coming months, it is almost entirely due to factors that are not directly linked to underlying cost and price pressures in the economy, and factors that we expect to be temporary. Chart 4 shows a decomposition of this. The combined effects of regulated price changes and fiscal measures may add around 0.5 percentage point to inflation towards the middle of this year. That's the orange, blue and purple bars. Core goods and food price inflation measures have also ticked up, that's the pink and green bars. But the single largest driver is household energy bills, that's the gold bars. With current expectations for wholesale prices, energy prices may contribute as much as 0.75 percentage point to the increase in headline inflation expected towards the middle of the year. The winter has been colder than expected in Europe, and that has led to an increase in demand for natural gas, while suppliers remain tight. As Chart 5 shows, wholesale natural gas futures prices have risen by around 20% since our November report. The increase in European gas prices has led to an increase in the Ofgem price cap for UK household energy bills for the current quarter, and it will affect the cap for the second quarter of this year too, when it's announced by Ofgem later this month. But gas futures prices remain significantly lower than in 2022, and they are little changed further out. While energy prices are volatile and notoriously hard to predict, these are developments that should help to limit further increases in energy prices. Monetary policy cannot prevent such short-term influences on headline inflation, nor should it respond to factors that will fade by the time it takes its effect. But we should recognise that this short-term pickup in inflation introduces some further uncertainty into the near-term outlook for inflation. Utility and food prices are salient to the consumer, and we have to make sure that temporary increases in them do not feed through to lasting second-round effects on wages and other prices. With the underlying disinflationary process well underway and a continued restrictive stance of monetary policy in place, we can, however, be reasonably confident that the pickup in inflation we see ahead of us will be temporary, and much smaller and less prolonged than the one we have just put behind us. Today, the labour market is cooling. The context is one of a weakening in economic activity. Intelligence from the bank's agents suggests that firms are increasingly either reluctant or unable to pass through costs to consumer prices, given subdued demand. There are signs that the restrictive stance of monetary policy continues to work to reduce inflationary pressure in the economy. So looking further ahead, as in Chart 6, our February projection, which is conditional on the market-implied path for interest rates, this suggests that consumer price inflation will peak this year at around 3.7%, and then fall steadily back to the 2% target over the rest of the forecast period. In our projection, the return of inflation to target is supported by an emerging degree of economic slack in the UK economy. Activity in the economy has been weaker than expected last year. We now expect GDP growth to be notably weaker in the near term too, before picking up from the middle of the year. We expect similar growth rates for 2026 and 2027 as we did in November. There is considerable uncertainty over the extent to which this weakness in GDP should be ascribed to demand or to supply, and so what that weakness means for inflation. Metrics of business and consumer confidence have deteriorated over recent months, and contacts of the bank's agents report that consumers are more price conscious and holding back on spending. This is consistent with a slowdown in demand. Equally, the disinflationary process has been slow too, and both services price inflation and pay growth remain at elevated levels. Price balances in business surveys have increased while activity balances have fallen. This suggests that demand has been slowing against the backdrop of continued weakness in the potential supply capacity of the economy. Our February projection ascribes much of the weakness in economic activity to supply. This means that the more recent slowdown in demand has so far led to only a small margin of slack opening up. The output gap then widens over the next couple of years of the projection to around 0.75% of potential GDP, before narrowing towards the end of the forecast period. This is consistent with current measures of slack in the economy. Both the level of vacancies and the ratio of vacancies to unemployment have returned close to pre-pandemic levels, suggesting that the labour market is broadly in balance. I would also note that the ratio of broad money to GDP, shown in Chart 7 here, has returned close to its pre-pandemic trend, though it's also clear that the slope of the current direction of travel is downwards. While we would expect the underlying disinflationary process to continue, The balance between aggregate demand and supply is one of the main determinants of inflationary pressures in the medium term. This will influence the path for bank rate. On the one hand, greater or longer lasting weakness in demand relative to supply would push down on inflationary pressures, consistent with a less restrictive path for bank rate. On the other hand, if supply is more constrained relative to demand, domestic wage and price pressures could be sustained, consistent with a slower path of future reductions in bank rate. There are risks from the global economy too. It remains unclear what form global trade policies might ultimately take, and the MPC's February projection is not conditioned on any change in global tariffs. A box in the Monetary Policy Report sets out a framework for how tariffs could affect UK output and inflation. So let me conclude. Our restrictive stance of monetary policy has reduced inflationary pressures in the UK economy. With the progress we've made, we've been able to take another step in making monetary policy a little less restrictive today. The judgment we will have to make at our future meetings is whether underlying inflationary pressures in the UK economy are easing enough to allow further cuts in bank rate. Some domestic inflationary pressures remain and may have eased a little more slowly than we expected last year. And that reaffirms the importance of taking a gradual approach to the withdrawal of monetary policy restrictiveness. Bank rate is not on a preset path. With increased uncertainty and risks to inflation on both sides, from the near-term outlook to UK activity and inflation and from developments in the global economy, we must also proceed carefully, judging the evidence afresh at each meeting. Based on the committee's evolving views of the outlook for medium-term inflation, a gradual and careful approach to the further withdrawal of monetary policy restraint is appropriate. And so with that, Claire, Dave and I will be happy to take your questions. Thank you.
Fabulous. Thank you very much. So let's take questions now. If we could stick to one, and then we'll see if we have time to go around again afterwards. Please give us your name and who you're representing. Can I start with Sam and then Ed?
Thanks, Sam Fleming from the FT. Governor, as you know, the markets have been taking gradualism to indicate a roughly quarterly pace of rate reductions, but your new forecasts are predicated on January market expectations, which point to a much slower pace of reductions, and that leading to inflation only just getting back to target in 3 years. So do we need to rethink what gradualism means? Why are you seeing such a slow disinflation process, given the cooling of the economy you're also describing? And can you just amplify a bit what you mean by this new word, careful? Thanks.
So it's good you asked the whole question, because I want to be very clear that you should see gradual and careful together. And you should also see, by the way, from the minutes of the MPC, that there was quite a debate about the choice of the second word. There wasn't a debate about the choice of the first word, because, as you know, we've been using that for some time. And I think we've been clear for some time that the word gradual has really been used by the committee in the context of our reading of the signs of inflation persistence, obviously coming out of the experience that we had a few years ago, particularly, and how that persistence was wearing off, over what time it would wear off. Now, I think we've seen good progress on that front, but we continue to use the word gradual because we continue to have to see that process of disinflation take place. Now, as you rightly said, Sam, we've added the word careful deliberately, and let me emphasise, as I did, that around that you should see the greater uncertainty that we face in the current environment. And as I said, that uncertainty is both domestic and global. So the domestic uncertainty is around, particularly, as we've set out at some length, I fear, in the report, because you'll have to read it all, the interpretation of the weaker growth profile and to what extent it's demand and to what extent it's supply. And underpinning that, also, frankly, the challenges in reading some of the data at the moment, and particularly on the supply side, I would say. So, if you look at the evolution of the last 12 months, we've had an increase on the supply side. We've had an increase in population. I think we've had an increase therefore in labour supply. We haven't had a change in GDP. Therefore, you can only conclude mathematically that productivity has got much worse. And you can see that in the term because it's actually negative. Now, I think there's a lot of uncertainty around what the true story, what the true position here is, frankly. By the way, it's one of the reasons why we do think growth is going to pick up, because it would be unusual for that negative situation to remain, frankly. I'll use unusual, advisedly. And then, of course, as I said, there's also global uncertainty. I mean, in a sense, we're all witnessing it from day to day. So there is there is heightened uncertainty. It's two-sided, as we've stressed. So, it could lead to conditions which actually make the path of disinflation less assured. It frankly could also, on the other side, lead to conditions which have the opposite effect and lead to it being a faster path of disinflation. But there is more uncertainty. That's why we've paired gradual and careful.
Ed next.
Thank you. Ed Conway from Sky News. Governor, last week the Chancellor unveiled her growth speech and many different reforms that she says will be growth positive for the economy, planning reforms, new runways, new reservoirs, and so on. I just wonder, I presume by now you've had a chance to look at that. Can you tell us what is the impact of those measures on the economy?
Well, yes, we have. I mean, I'm a very, very strong supporter both of the growth agenda that this government had, and by the way, the growth agenda the previous government had as well. I mean, this is, we've told the story quite a few times that the potential growth rate in the UK has been low since the financial crisis, and that obviously has an effect on our policy environment and has an effect on other policy environments as well. And addressing those questions is critical. So, very strongly agree with the Chancellor on this point. Now, what I will say is, of course, structural policies take time to come through. So when we're looking at obviously a 2 to 3 year horizon here, you wouldn't expect a lot of that to come through quickly. But I don't for a moment want to leave you with the thought that therefore we don't think it matters, because it does matter, because obviously what matters is what comes thereafter. But Claire, did you want to comment on this as well?
Yeah, I mean, I think that's I completely agree. I mean, obviously we are very supportive of measures that raise growth in the long term, and her speech was focused on those. They were structural reforms. The UK, actually, like lots of advanced economies, has a challenge on productivity. That's the sort of challenge of our time. Those sorts of structural reforms. I mean, look, I spent a lot of time at the OECD. This is the sort of meat and drink that we spent a lot of time on. It is structural reforms that will drive that long-term growth rate. It's absolutely the right thing to do. The UK, like lots of advanced economies, actually needs to do an awful lot in this space. But in terms of the forecast horizon that we use, obviously you wouldn't expect to see a change in that because of these sorts of policies. You would expect to see it over the longer run. Obviously helps. These things are important for everyone, right? Across the UK economy, as we all know, it's the only way to get rising real incomes in the long term. From our point of view, as sort of monetary policy setting, it also matters because it's the speed limit for the economy in terms of supply. So, hugely supportive, right sorts of things to be focused on, and so we would hope that medium longer term it will help raise supply in the economy. As Andrew says, it's incredibly hard to make these judgments about supply, and particularly in the shorter term, more cyclical supply that we have to think about for our policy rate setting.
I thought I'd come just to reinforce what Andrew and Claire have said. I mean, if you look at chart C, as Andrew was saying, the quite long box on where we explain our thinking on supply, you can see just how unusual the performance of potential productivity, which is something we assess and judge, and there's uncertainty around it. But potential productivity growth has been really weak since the global financial crisis, but particularly we think last year, as Andrew was saying in his first answer, given the other developments we've seen in population, and given that GDP has really been flatlining since last March, we've had to mark down potential productivity. As Claire was saying, that in turn means that the speed limit in the short term is lower, But as Andrew was saying, there's good reason to think that potential productivity will pick up, and what the Chancellor announced were very important set of reforms that over the longer term will support potential productivity picking up.
I think, by the way, look, I think the one thing to your point, Ed, I think it is important that being committed to these reforms and showing real signs they are going to happen will have a confidence effect. So in the shorter term, you might get something like that. Joel's now so excited that we've got...
Can we have Faisal and then Joel?
You just have to contain it, Joel, for a moment.
Faisal Islam, BBC News. Governor, I think it's flat growth from last March all the way through to the middle of this year, and inflation rising all the way through to the autumn. Is this a light or even a medium form of stagflation?
Well, I don't use the word stagflation. It really doesn't have a sort of a particularly, frankly, precise meaning. Moreover, let's go. You've talked about the growth profile, and you're right. I mean, obviously, we've had essentially a flat economy over that period. We obviously, by the way, in the early part of last year, had a faster pickup than we were expecting, but since then, we've had a flat economy. But let's go to the second part of the term, which is the inflation part of it. And I just want to re-emphasize the point I made, which is that the judgment that we've made today, the heart of the judgment that we've made today, which has allowed us to take the next step in reducing interest rates, is about the continuing path, we think, of disinflation, and why I put so much emphasis on services, on how we're reading the labour market, on how we're reading pay, because there is noise in the pay data as well, we think. And that is the key. So in terms of pushing back on stagflation, I really would come back to that point, that our judgment today is really anchored on a view that we think the disinflation trend is in place.
And it's also worth putting it in perspective. The euro area also saw no growth in Q4.
Yeah.
Our inflation rate is the same as the euro areas at present. So we're expecting inflation to pick up in the short term, but we are also, as Andrew stressed, expecting GDP to pick up. Our forecasts, once you get into next year, are similar to last November.
Okay, I've got Joel and then Jess here.
Joel Hills, ITV News. I have a couple of questions, if I can. Governor, we saw quite a sharp rise in bond yields and a weakness in sterling a few weeks ago. That's quite an unusual mix. To what extent do you think that was caused by a loss of credibility here in the UK, or do you think it reflected global factors? And my second question is about box A, R star. In 2018, the bank estimated neutral at around 2.25%. You've referred to three estimates, I think, in box A. Which of those, how are you weighting those? Do you put equal weight on all three, or more weight on one or two of them?
Right. I will say a few things. Then I'm going to get Dave to come in on bond yields and Claire to come in on R-star. So on bond yields, we've actually got a chart in the report, and we use a technique which we call a rigor bond decomposition to, in a sense, decompose the movements in bond yields. And what you find is, and by the way, this is pretty much the norm with the UK curve, is that, of course, it moved essentially with the US curve. You can see in the chart, quite interesting, there was 1 week, essentially in January, when you can see a sort of quite a UK contribution. But this sort of movement up, and then, by the way, of course, what we've seen since then, which is the movement down in the curve, has been really led by the US. And you can see from the chart that I think our market has followed. So I would use that to avoid, any sort of, say, making great commentary. I don't think it's right to make great commentary about what the UK has done here, because it is actually much more of a global trend than that. Dave may want to say more on that. On R-star, I'll let Claire come in, but I would simply make the point that we've been very clear in the box that R-star, we've had this discussion many times, it's a very useful concept. It's very useful to look at it as it's a global concept, and particularly for a small open economy like the UK. There are reasons we think why there may have been some upward movement in R-star in recent years, and not just here, by the way, generally. But in terms of the various measures, we do not publish them to then put weight on one or the other. Frankly, we're laying them all out. There is a high degree of uncertainty around this, and as we say, that's why we don't use it for setting interest rates. Dave, did you want to come in on?
Yeah, just
on the
and just to help with giving a bit more detail on the answer on the first question is chart 2.8 on page 31, Joel, which sets out. I mean, this is just over the period. I mean, you can look at these decompositions over much longer periods, but this is just since the 31st of October, the November report. And the aqua or turquoise bars for the the spillover from global shocks influence on UK yields is much more significant cumulatively than any role for UK factors. There was a week, the week in January when UK factors, according to this decomposition, which is the best we've got, but it's inevitably a bit imprecise, UK factors were 1/3 of the total, and we were very clear on saying that at the time. Sarah Breeden was giving a speech over that period that that this was fundamentally global factors being driven by perceptions and expectations of US fiscal policy, and then there was a little bit of a UK overlay. But if you look at the very latest bar, UK shocks actually pulled down, and that was probably a reaction to a marginally lower UK inflation rate than was expected in that week. So that should give you some perspective and context on that. The other thing really worth stressing over that period, if I can, in fact, the whole period, is that UK markets, gilt markets, have been operating in a very orderly way. There has been some repricing in response to news, whether it's fiscal perceptions or, as I was saying, inflation. But they've been responding in a very orderly way, and our facilities have been operating exactly as you'd expect them to. Our short-term repo and index long-term repo facility to provide the liquidity that the market's demanding.
Yeah. Let me add a bit on the R-star, the neutral interest rate box that I'm very pleased we've put out, because it allows us to explain how we think about these concepts, how we use them. I mean, and I would distinguish between the kind of very long-run equilibrium global concept of sort of R-star, as people call it, and sort of where the cycle might end up. But this is useful, and a useful thing for us to think about for two reasons, really. One is sort of conceptually, this is how we think about the balance of sort of demand and supply for capital and savings. And think about how that evolves in the long term in response to structural factors. Some are laid out in the box. It also feeds into the kind of basket of ways we think about restrictiveness. I would say we monitor that in lots of ways, and we put an awful lot of weight on looking at the data and across the transmission mechanism, including credit conditions. So it's one of the things we look at. I wouldn't say it's the dominant. We spend much more time looking actually at the sort of more near-term data and how the economy is responding to those. We've put out some estimates in the box today, basically to lay out the sort of whole landscape here. I would strongly advise against trying to derive a point estimate from that. It would imply a level of certainty that you just don't have. These are big kind of moving things. But we have said in there, in the period between the global financial crisis and before COVID, we had an estimate of around 2 to 3%. If you look at a broad range of models, if you look at sort of market-based measures, that gives you that sort of range. We've also laid out the structural changes over economies seen through the pandemic and beyond, and we think that would drive up slightly, marginally, those numbers, maybe by 0 to 1%. You can add all that up and say perhaps we're in the region of 2 to 4. Right? It's very broad. I think it's really important not to sort of assume a level of certainty around that. We can't be certain. It's completely sort of unknowable, unobservable thing, but it's an important concept we think about, and that's why we wanted to lay it out. On your question of lots of different models basically saying, do you take a weighted average of them? No, we've set them all out to show the level of different views and uncertainties out there. Depending on what model you use, depending on where you get your data from, you'll get a very different. No, we
Equal uncertainty.
they're just there. They give you a sense of the uncertainty around this concept. That's the point of it. We also feed into, and as I say, I would really stress when we're thinking about restrictiveness, actually we look at a much wider basket of things than this.
For our viewers will be that you talk about interest rates being restrictive, but don't seem to have very much of a clear idea of where neutral is.
No, but Joel, can I just, on that point, because it's an important point, we don't judge restrictiveness just by looking at a model of R star and the neutral rates. We judge restrictiveness by looking at the transmission mechanism of monetary policy, and then, of course, how it affects the output gap. So those are the things we observe. I mean, merely using a theoretical model, I would not advise your viewers to do that if they want to maintain a theoretical model, because it's not going to give you a very good read.
Okay, now I've got a long list, but don't worry, we've got time. We will get round to everyone. I have Jasia, and then, if you wouldn't mind passing to Heather afterwards, and then I'm going to go over to Stephen, Ashley.
Hi, Yasha Popovic from Central Banking. I wanted to ask about gold, given it can act as an inflation hedge and the current liquidity stress, in what you said yourself last week is one of the world's major markets. So how much gold has now left the BOV vaults in anticipation of tariffs? And with bullion banks looking to borrow from central banks that hold their gold at the BOV, what is the central bank doing to help alleviate current queues?
Dave, do you want to?
Yeah, I think I picked up the question. And look, there's, it's worth, given that this is the NPR press conference, it's worth putting what's been happening to gold, which is the detail of your question, in the context of what's going on in the world economy and the uncertainties out there. And, it's also worth bearing in mind that, because this helps explain some of the facts around the time it's going to take to get gold out of the bank's vaults, because of the nature of our approach to the gold. So, I mean, the first thing to say is, and I think this is broadly known, but, we have the second largest stock of gold in the world, over 400,000 bars of gold at the moment. That's gone down a bit since the end of 2024, reflecting the market conditions that you're talking about and have been a feature in the news, but the stock has gone down by about 2% since the end of, so that's important to keep that in perspective. And the US gold market has been trading at a premium to the London market, and commercial gold holders have been looking to take advantage of that price differential. So they've been, there's been strong demand for delivery slots. We can meet that demand. All of our main counterparties, as it were, or better to say, all of those bodies who ship the gold have, they've all got the delivery slots they need over the next few weeks. If you were coming in new to us, you might have to wait a bit longer because all the existing slots are booked up. But this is a very orderly process. It is worth stressing compared to some of the markets we usually talk about. I mean, it's an obvious point, but gold is a physical asset, so there are real logistical constraints and security constraints. Getting into the bank for me this morning was a bit trickier because there was a lorry in the bullion yard. I mean, that's how it. But that's just the reality of it. It takes time, and the stuff is also quite heavy, as you know. So, I think these things sometimes get forgotten about in a headline that says, there's a 6-week delay or something like that. There's a lot of demand, but we've got slots for all the people who currently want to get their gold or want to ship gold on behalf of a customer, and we're managing it.
Can you pass down to Heather, and then we're going to go over to Steve and Ashley next to each other.
Heather Stewart from The Guardian. I know you've said that the current forecasts aren't conditioned on any particular outcome for trade policy because, of course, there's a lot of uncertainty. But I know you've looked at this in the report, and I wondered if you could just talk us through the potential impact on the UK economy of tariffs. And just, I think you implied this, but is the political uncertainty one of the reasons you're now being careful about monetary policy as well as gradual?
So, by the way, we have included a box in the monetary policy report which sets out, a framework for thinking about exactly a question, which is obviously a very important question about how to think about the effects of tariffs. And I would, and you're right, of course, in my commentary on uncertainty, yes, this obviously does feature in that in that assessment. So, two things I would say on the sort of the direction of impact. One on growth, one on inflation. So I think that if there were to be tariffs that contributed to what I would call a sort of a fragmentation of the world economy, then that would be negative for growth in the world economy. I think we have to be very clear on that. I hope that doesn't occur, but that would be, I think, a result. It's not hard to, in a sense, derive that result from thinking about the sort of negative effects on trade. Effects on inflation, as we set out in the box, are much more ambiguous, actually, and that's because in a country which is sort of not the originator of the tariff, if you like, as the UK wouldn't be, and that's because it depends upon a number of things. It depends upon, obviously, what the reaction of other countries is to the tariffs. It depends on to what extent the tariffs lead to a redirection of trade, and to what extent that affects the trading patterns of other countries. And it depends on movements of exchange rates, all of which are important. So, we're very clear in the box that you can't make, a clear and unambiguous, in a sense, prediction on what would happen to inflation in that context, because it depends on a lot of things. What I can assure you is that although we haven't factored in any adjustment in tariffs into our assessment in the forecast, because frankly we just don't know what's going to happen, and I think events of the last week have illustrated that. We of course follow it very, very closely.
If I could just add on that, I mean, I would say it links a bit to the earlier question we had. In the very sort of long run, beyond our forecast horizon, obviously a reduction in trade would be inflationary through its effect on productivity. There is a very strong clear link between trade and productivity. If you look historically, if you look internationally, you can see that very clear, but that would obviously be long term.
Thanks. We've got Steve and Ashley, and then I'm going to go to Phil and Steve.
Steve Sedgwick, CNBC. Governor, the market seems to have got a little bit overexcited about the Catherine Mann conversion to a dove from a hawk as well, and seems to be, according to the headlines, pricing in more aggressive rate cuts from here. Having sat in the lock-in for 2 hours, have I missed something? Because as far as I can see, actually your forward projections are less dovish on interest rate cuts. First quarter 2026 looks a lot higher. End of the forecast period looks a lot higher, around about 4%. So have you got a message for the markets that they've misread your gradual and careful message? They seem to be getting carried away that we're going to have more aggressive cuts. From what I can see from the report, it looks less aggressive, the cuts.
Well, I think that, first of all, obviously, there is no groupthink on the MPC, as I've said many times, and each member obviously votes as they think best. Catherine will, I'm sure, be speaking in the near future and will explain her position in much more detail. There is, of course, a paragraph in the minutes which sets out the voting position of the minority. So I will leave Catherine to explain her position because I think that's appropriate. But I would come back to this. I think it's important to focus very much. It was a 7-2 vote, so there was 7 members. Took a reasonably similar view, identical view on the actual decision on rates. You'll see in the minutes box there were some differences of view within the 7 on the language, and that can be boiled down really to the choice between the word careful and the word cautious. Actually, as you'll see in the minutes, you can see that coming through in the minutes. And so I would just be very, very clear that the position of the majority of the committee, which of course eventually decides the outcome at any meeting, was conditioned on that, and I would not therefore over-interpret any other moves in voting patterns. I really wouldn't.
Over-interpreting the forward interest rate cuts from here, i.e. they seem more, I think there's going to be more aggressive cuts from now, and you're not saying that in the slightest.
Honestly, what I would say to that is that I think it's important that the view on the future path of interest rates is based on the sort of economic fundamentals. I mean, that's what really determines it. And there I'd come back to this point that we made in the report. We think the path of disinflation remains in place, very much as we had it back in November. There will be a bump in the road, but we don't think that bump is going to have a long-lasting effect. And there is a lot of uncertainty, coming back to the point I made earlier to Sam, about the degree to which the path of activity is going to be supply or demand driven. And that really is going to be, if you think what's going to shape this, how that sort of shakes down is going to be the thing that really influences it.
And the only thing I'd add, if I may, I mean, we've said this before, I mean, the market is obviously entitled to its view, both in terms of where it thinks rates are going and where they're trading. We have to take a 15-day average. We've seen movements since then, as we've seen before. But back to Andrew's emphasis and our emphasis on gradual and careful, I mean, we've been saying gradual since near the start of the cutting cycle last August, and I think developments in the economy have validated a gradual approach. And as we've stressed in the current report, there have been important developments since November and in the last few weeks. But those we're trying to frame those in terms of the uncertainties that Andrew was emphasising around how much of the persistence in inflation can be explained, but also how much the weakness in activity is demand versus supply. That's a kind of critical uncertainty for us, because that will have implications for the persistence of inflation.
I've got Ashley, then Phil, then Sue.
Thank you. Ashley Armstrong from The Sun. So most Brits will be watching what you've done today and what you're saying in relation to what it means for their own personal finances, of course. And in your report, despite today's interest rate cut, you say that around half of households will actually be having to remortgage at a higher rate over the next 3 years. If we add that also with your projections for lower growth than expected, higher inflation, what does it actually mean for most Brits' pockets? Are they going to be better off over your forecast projection period or not?
Sorry, it means...
Do you think that there will be, as a result of the higher inflation, the higher mortgage monthly costs, the lower growth, will they be better off or not over your projected forecast period?
Well, of course, in terms of mortgage rates, as we've discussed before, I mean, they are priced off the interest rate curve. And the interest rate curve, of course, has been, the market was essentially pricing what we've done today in for some, I don't think the market was surprised by what we did today. So I don't think that will have a major impact on mortgage rates, because I think they've already been anticipated to a considerable degree. Now, as I set out, we do face what we think is this sort of bump in the road on inflation. And as you can see, I spent quite a bit of time explaining it, because I think it's important to just, in a sense, set out all the reasons we think this is that are causing this: energy prices, some utility prices, but then to come back to the point, we don't think that's going to have a lasting effect. However, I want to be very clear, because you raised a very important point. There is, of course, we target inflation. That's our job. We do recognise that the cost of living is a different concept. It's a levels concept in terms of prices. So yes, I mean, it does concern me, obviously, that these impacts of these one-off effects do impact the cost of living. Now, we are seeing, of course, in general terms, we're seeing pay increase in the economy, leading to an increase in real earnings, and that's obviously helpful in that respect. So I would stress that point. But I always want to be very clear, because I think it's so important to know for your readers that we do understand this distinction between inflation and levels.
And just on, if I can add, Andrew, on mortgages, because it's linked to the point that we've been stressing, that because the disinflation process has been continuing, we have been able to reduce the degree of restrictiveness of monetary policy. I mean, just to take, if you look at chart 2.9 on page 33, the key reference rate for the, take a popular mortgage, the 2-year 75% LTV mortgage, the reference rate has come down from its peak in 2023 from the OIS curve. But the actual, the quoted rates for those mortgages, they peaked at just over 6% in 2023, similar to where they were back in late 2022. And they're now significantly lower than that, below 5%. So they're still relatively high compared to before inflation started to go up and we tightened policy. But mortgage rates are coming down, and that over time will support the economy and is supporting the economy. I mean, you quoted one statistic which is correct, but it's also the case that just over a quarter of mortgage accounts are expected to see monthly payments decrease between 2024 and 2028 Q1 because they're either on variable rates or they were fixed over that period of higher rates. And now as we get into the period of gradual reductions in rates and that feeding through into mortgage rates, that will support the mortgage market and demand. And elsewhere in the report, we emphasise that we think that the housing market is picking up.
Okay, thanks. I've now got Phil and Sue, and then I was going to go to Graham and Maureen. We've got about 15 minutes left. I think we will get to everyone, but we'll...
Thanks. Thank you, Governor. Phil Aldrich at Bloomberg. You've done a bit more broad analysis of the impact of the NICs rise from the budget now, which you say that it will lead to more job losses, I think, than you were anticipating before, and also higher prices. At the same time, you've downgraded your short-term estimates of the supply capacity for the UK. Are the two related? And even if they're not, I mean, what is the sort of general impact of these NICs rises? Do they contribute to? Do they make you more careful, or do they encourage you to continue with the gradualism?
I would say, Phil, that we really haven't received evidence and information since the last forecast, which really has changed our view. Particularly, we made a small adjustment, as you rightly said, but we haven't seen evidence yet that really changed our view on the impact and channels through which the NICs effect will come through. We talk a lot to businesses. We've got our decision maker panel, which we explicitly asked about it in. We've got the agents, all of us, when we go around the country, obviously talk about it. I think it's fair to say, and I certainly find this when I talk to businesses, that at the moment when we lay out the channels of how this can come through, that businesses tend to say all of the above. I think they're very much waiting to see how this will affect. One point we did draw out more, which I will point to, is that there will, of course, be one area where one of those channels will be constrained, because the effect of the national living wage increase, and I'm not saying this to be talk critical of the national living wage increase, just to be clear, but it does, of course, constrain the adjustment channel or the wage adjustment channel in the NIC adjustment for those employers who've got a higher proportion of employees that are at or below the national living wage. So that's one channel. But big picture, we really haven't yet changed our view. No, not really. No, it's not a particular factor in that.
We've got Sue, then Graham.
Hi, Sue Chan from The Telegraph. You've cut your 2025 growth forecast in half. How much is that to do with the budget? And just to be clear, given, as you said, you devoted a chunk of your opening remarks to stressing that the spike in inflation this year will be temporary, does that mean you are comfortable cutting rates further against a backdrop of what you say is a backdrop of rising headline inflation?
So I'll take them in reverse order, if you don't mind. So let's go back to what I said at the beginning. We do see a pattern and a picture where the disinflation trend remains in place. And I spoke quite a bit about services inflation. Now, we'll have to watch this, as we always do, of course, as you'd expect us to do, carefully. But that will be the backdrop to decisions on interest rates going forward. And as I said, I said earlier, my expectation is that the path remains downwards, but there is more uncertainty, and that's why we've introduced the word careful, frankly. But you know, I would say the path, my expected path is downwards, but there will be, you know, the word gradual and the word careful can, you know, apply very much. So those are the ways in which we'll judge it. On the first part of your question on the growth forecast, it's not sort of goes back to Phil's question really. No, it's not a judgment on the budget in that sense. The judgment really is that, as we said, growth has been flat as measured since, you know, really the sort of spring of last year, actually. So going back before this. And we've had to then, you know, say go through this process of to what extent is it supply or demand. But we've had to revise down because, frankly, the evidence is there. Now, it's left us with, as I said earlier, with quite a few puzzles, frankly, as to what's going on. Particularly because of the way in which the increase in population will come through and what effect that has. Because as I said earlier, just going back to Sam's question, yeah, we've got more population, we've got more labour force, and we've got the same output. So you can only conclude then that you've got lower productivity. But negative productivity, just to re-emphasise the point, is not. It would be very unusual if that persisted. Frankly, I mean that's a very odd situation to find yourself in. So that's the real backdrop. It's not a point about the budget, really.
Fab. I've got Graham and then Marine.
Thanks. Ed Frankel from the Wall Street Journal. Given in the monetary policy report you go at some length into saying that tariffs, the effect of tariffs will have an unclear effect on inflation, how long will it take for the bank to finally assess the impact? And perhaps as an addendum to that, you did say the report is not conditioned on any changes in global tariffs. So for the record, does that mean if any are implemented on major economies like in Canada or Mexico of recent weeks, that would decrease growth in the UK, or would it make it less likely that inflation would reach 2% by the end of 2027?
Well, first of all, I mean, I think to your question, obviously, and you know, we've seen this week. Look, I think we're going to have to give the administration in the US time to, you know, to form the policies it wants to form, and then we can judge the effects of those. Because we're just not in a position to judge these effects at the moment because we don't know what the policies are. I mean, they do change from day to day. So, you know, we've now got a 30-day period where, you know, there's a sort of, you know, a process going on, we presume, but we don't know what that is and where it's going to end up. So I think we have to let that, let that take its course, and then we'll judge it. But of course, we will judge it when it happens. Now, to your point about, you know, tariffs on other countries, well, again, you know, we would have to judge, you know, the significance and the impact of those. Go back to the point I made earlier. If there were a broad increase or a broad move towards what I call fragmentation of the world economy, that would be a very significant thing. Now, I said earlier that the impact is clearer on growth than it is on inflation, but we would have to make that judgment. Now, individual tariffs may or may not get us there. We'll just have to wait and see where they go to.
Okay, I have got Marine, Chris, Tim, and then Eshe. I think that might be it. We'll see.
Hello, Marine. Just actually had to step out. Jack Bonnet from The Times. On the supply stock tape, which you've updated in the report today, is slightly lower than what you had previously. Can you just elaborate a bit more on that? I'm sure there'll be some repeated points in terms of how poor productivity has been, even though we've had this increase in the population. Yeah. Can you just elaborate a bit on that? And then can you also just potentially point to some policies which may reverse that trend and try to stimulate potential supply as well?
Well, let Claire come in. Obviously, one policy will be to get the LFS, the Labour Force Survey, more firmly established and based. Yeah. But Claire.
Let me talk about this a bit. I mean, look, it's very hard to judge the supply capacity of the economy in the short term or the long term, right? It depends on the size of your labour force, your capital stock, productivity. These are all quite difficult things to measure. We have had some new information. So in particular, we've got new population data. which the ONS has released. We've sort of fed that through into some of our long-term judgments, particularly about the labour force. They haven't yet put that through the latest data into the labour force survey, which is obviously really, really important to us. When they do that, we will take it on. But at the moment, what we've got is a slight increase in population size and labour force size, as you can see, which feeds through to the long-term numbers. We haven't made sort of radical adjustments there. As Andrew said, the thing that matters most from a kind of rate setting, policy setting, is actually the sort of short-term supply and how much of this activity change that we've seen in the fall in activity is demand or supply. I mean, on policies, that's not sort of for us to comment on, but I would refer back to the comments we made earlier about productivity, and really that is the thing that, and this is, as I say, not a UK problem. All advanced economies, with the exception of the US, have been suffering a really sort of challenging time on productivity ever since the global financial crisis. So, the sorts of policies that would address that around, public investment, private investment, all of those sorts of things are exactly the sorts of things that you would want to.
Is it still very tricky to get any sort of gauge from the labour market as a result?
Well, look, it's not. So we get a gauge on the labour market by looking at a whole range of indicators. Obviously the LFS is a part of that, an important part of that, because of the well-known challenges with the LFS. We now look to a much broader range of indicators, as we've talked about before. I mean, look, the ONS is committed to improving it. We're working with them. Improvements are happening. They've boosted the sample size. That is very, very welcome. There's still quite a lot of work to be done. They're very committed to doing it, including things like mapping it to the latest population data, including boosting the sample size. There's a whole set of things that we've set out, including publicly, what it is we need to see there to be able to use the stocks data and also the flows data, which are really important to us. So, it remains a challenge. It remains a sort of area that everyone's working to improve. But on the labour market as a whole, as a result, we look at a broader range of indicators, and in some aspects of the labour market, that's more helpful than others. We can get a really good gauge on wages. We can get a good gauge on things like employment from other data sources. Some of the issues around participation a bit harder.
I mean, just to give you a graphic example, if you look at charts 2.14 and 2.15 that show employment growth and the unemployment rate, you can see that the LFS numbers are pretty volatile, and the indicator models that we look at for employment growth and for unemployment are much more stable and just give more of a signal.
Okay, we can run on for 5 minutes just to make sure we get to these last few. I've got Chris and then Tim and then Eshe.
Chris Giles from the Financial Times. Just to characterise the decision and the forecast today, it looks as if the data's been pretty good and disinflationary, and the decision is pretty dovish, but the forecasts are pretty terrible, with higher inflation across the forecasting horizon and lower growth across the forecasting horizon. That does make people ask the question, do you believe your own forecasts? And assuming you do, why is the UK, we've had meetings with the other big central banks recently, why is the UK apparently alone in having such a difficult time in getting inflation down compared with other countries?
Well, the forecast is an important input to the policy decision, but it's not the only input to the policy decision. And I've made quite a point today, and it's important that there is a lot of uncertainty around. I think it's an interesting question. Look, we've set out, and I really, deliberately today spent quite a bit of time explaining what lies behind this short-run pickup in inflation. Because it's important. It's important to explain it so people understand it. It's also important to then, in a sense, take the message that we have taken in terms of what we think will be the consequences in terms of inflation persistence, which we think will be very little, actually. Now, look, when you look at that pickup, some of it is quite UK specific, or it is completely UK specific. Things like water water charges, bus fares, and so on. In that area of sort of utility and sort of administered charges, it is very UK specific. The energy story is, of course, a mixture. I mean, as I said in the chart, what we're really seeing it's a pickup in gas prices in Europe over the winter, 20% increase since we were here in November. That, of course, the gas market is a European gas market, so the weather, of course, is European. So these pipeline disruptions are European because it's related to Ukraine. There's some disruptions in Norway, I think, as well. But of course, how it feeds through into energy pricing is quite country specific because each country has a very different way of doing it. So we can map it for the UK because we know we sort of pretty much know how Ofgem do the cap. So yeah, there's a mixture there of UK specific and other elements. But there is, I would say, Chris, there is quite a lot of UK specific stuff in there actually.
Even in 2027 at the end?
No, not in 2027. No, I'm talking about the hump in the short run.
Yeah. And it's worth saying, I mean, we quoted the figures earlier, but inflation has ticked up in the euro area. You do get these short-term factors. As Andrew was emphasising earlier to your comment about the forecast, after this year, growth is very similar, GDP growth, to what we were forecasting back in November. And there are other strengths that the UK economy has. I mean, measured unemployment, I was just talking about it being volatile, but it's still measured at about 4.5%. I mean, unemployment in the euro area is close to record lows, but it's still at 6.3%. So, there have always been trade-offs between a flexible labour market and what that might mean for productivity. That's one of the characteristics of the UK.
Right, last two, Tim and then Nishi.
Thank you. Tim Wallace at the Daily Telegraph. On productivity, Governor, the report shows clearly the public sector is expanding quite rapidly. Public sector productivity growth is not very good. Can you explain why that is, and also how productivity growth in the wider economy can rebound at a time when it's the public sector driving growth?
One of the things that we do point to in the box that we did on supply side is that, and actually, by the way, this goes back to 4 or 5 years actually, that there's been an increase in public sector employment relative to private sector employment. Now, public sector output is measured by a whole series of, if you like, sort of conventions. So I think it's fair to say that we have seen an increase in public sector employment. We haven't seen a commensurate increase in measured public sector output. So part of the story is that one. It's not the only story, as we set out in the box. Again, I can't tell you, Tim, to what extent that's a sort of a real phenomenon and a measured phenomenon, because I say there are sort of conventions in terms of how you measure outputs in the education sector, how you measure it in the health sector. We spent quite a lot of time looking at these during COVID because it became quite challenging during COVID, of course, as to how to map these. So it's an issue. I think I would caution about drawing sort of any strong conclusions about what you think about what's going on in the public sector, because there are a lot of conventions about how these things are measured.
Last one.
But we'll come.
Okay.
Isha Nelson from the New York Times. Just quickly, the Federal Reserve left the network of central banks and supervisors for greening the financial system. What impact do you expect this to have on the network's activities, if any, and also just kind of on the general sense of commitment towards these goals? And have you had a chance to speak to US Treasury Secretary Scott Bessent?
Well, the Federal Reserve has left the network. It's a choice that each central bank makes. Obviously, membership is not compulsory. And each central bank has different objectives in its remit. And so I respect the decision that the Federal Reserve has made. We have decided to continue to be a member of the network. And the reason that we are a member of it is not through any institutional position on the politics of climate change. We don't take any position. I think the network is useful for the macroeconomic modelling it does on climate change. So we value the fact that we can come together with the other central banks and think about the modelling of the long-term modelling of the macroeconomics of climate change. I think it's a good thing to do. It's important, but it doesn't go further than that. There's no judgmental, view buried in there about the politics of climate change or indeed anything other to do with climate change. I think it's just a good forum for macroeconomic modelling, and that's our decision. But I respect the decision the Federal Reserve has taken.
And then the bonus one for John Paul.
Thanks, John Paul Ford-Rockhouse from the Daily Mail. You talk about the increased inflation later this year being temporary, and of course a few years ago it was described as transitory, and that didn't turn out to be the case. So I just wonder whether the insertion of the word careful is a result of that perhaps bitter experience of a few years ago in terms of your plan for interest rate cuts. Just one other thing, if I may. The Chancellor recently gave an interview in which she talked in positive terms about a Goldman forecast that rates would be cut 6 times this year. Was that helpful or unhelpful to you as a central bank for the Chancellor of the Exchequer to be making those kind of comments?
Well, I don't think it has any real relevance to our decision. I mean, I think the Chancellor obviously can choose what she says. I respect what she says. She was commenting on an outside forecast, but obviously that outside forecast doesn't have any particular effect on our forecasting at all, actually. We'd obviously take an independent view, and that's it, frankly, on that. On the question of temporary and the pickup in inflation, look, the word gradual is, as I've said, is in there because there is more uncertainty. This is only one part of the uncertainty. We had a number of questions about trade policy, which of course is another area of uncertainty. Just to go back to your point about a few years ago, can I just say, look, there is a basic piece of economics around supply shocks and the way they feed through and don't feed through. And nothing, I think, has really changed in that respect. The problem we had a few years ago, in my view, was that we had a whole series of them, which came, very big ones, which came one after another. And, of course, you can't use the word temporary in the same context when you have this elongated series of very big supply shocks going on, because it just stretches the bounds of sort of, in a sense, understanding of that term. Now, two things I'll say. We don't see that happening today. But secondly, this is very important, you have to then put it into context. And let me just go back to 2 bits of context in my opening remarks, or 3 bits. We obviously are seeing a weaker profile of activity. As I said in my remarks, the labour market we think is in balance at the moment. And thirdly, just for the monetarists amongst everybody, we do look at monetary data. You saw the chart I used. I think that's the best way to sort of take the monetary perspective on this, to look at, not just to look at monetary aggregates from month to month, but to relate them to nominal income. It's actually, it's come back to its trend line, and as I made a point of saying, if anything, it's on a declining trend, and that's significant, I think, in terms of judging the situation we're in. So that's the way I'd look at it.
We really are done now. Thanks very much for coming.
Thank you.
Enjoy the rest of the day.
what if we